Good afternoon, and welcome to Know Before You Grow, mitigating the business risk of branding for banks in expansion mode. Whether you're exploring new markets, evaluating M&A, or challenged to differentiate, your brand identity could be a risk that impedes expansion or an asset that propels growth. This webinar ensures your future is well strategized from a branding perspective. We will explore 4 banks' journeys to understand how to reconcile brand challenges, protect the bottom line, and gain market share. I'm Laura Ramsey, Vice President Bank Director, and we thank you for joining us today. This webinar is brought to you by both Bank Director and Adrenaline. An information resource to the financial community since 1991, Bank Director focuses on the strategic issues most fundamental to a bank's CEO, senior leadership team, chairman, and independent directors. Adrenaline is an end-to-end brand experience company serving the financial industry. The company positions, designs, builds, and implements change for institutions as they scale. From brand to branch, Adrenaline partners with banks and credit unions to facilitate smart decision-making, develop strategies to boost growth, and deploy change to transform organizations. We are offering CPE, or Continuing Professional Education credits for this webinar. In order to qualify for credits, you must be in attendance for the full and complete webinar, and you must participate in all 3 polls. If you do want to receive CPE credit for this webinar, please email Taylor Zito at tzito@bankdirector.com. Certificates will be sent out 2 to 3 weeks after the webinar. Before we get started, let me share a few things to keep in mind. First off, don't worry, we can't hear you. You have joined this webinar in listen-only mode. We recommend that you click on the sidebar at the bottom of the screen and put the presentation into full screen mode. If you have any questions for our speaker, please note them by clicking the Q&A button found on the right side of your screen. You can do this at any time during the presentation, and once our presenters have finished with their talking points, we'll have a Q&A period where those questions will be addressed. There is no need to take detailed notes, as the presentation will be shared with all attendees within 24 hours via email. It will also be available on bankdirector.com. If you have any technical issues, you may also note those using the moderator chat feature on the right-hand side of your screen, and we'll do our best to take care of it for you. Regarding our polls, those will also appear in the sidebar near the Q&A button. When you've selected your answer, just hit the vote button to submit your response. Finally, the opinions expressed in this webinar are those of the individual speaker only and do not necessarily reflect the opinions of other speakers or of the entities in which the speakers are associated. On that note, let me share a little bit more about our speaker today. Gina Bleedorn is the president of Adrenaline. One of the original founders of Adrenaline, Gina has exemplified the company's culture and vision for 20 years, generating meaningful experiences that drive and deliver business advantage. Known for her razor-sharp customer insight, design brilliance, and ability to lead transformational change, Gina ignites audiences across the financial industry with thought leadership and storytelling. Gina, please take it away.
Thank you very much. Happy to be here. I'm going to share my screen. So today, I am very happy to be talking about something that I think the industry at large needs to hear more of, and it is about branding and really the business impact of branding specifically for institutions in expansion mode, in any type of expansion. This can be organic, M&A, or other. And I want to begin by explaining we have at Adrenaline over the past 20 years, as mentioned in the intro, I've been here a long time, and we've been rebranding financial institutions for a long time. And historically, brand has not been nearly in the consideration enough as soon or as prevalent as it needs to be in the C-suite and in the board. And this is becoming more and more of a problem every day, and those organizations that have made brand a consideration earlier and more significantly have benefited from extreme rewards from a business perspective downstream. And so I'm going to here tell some, I suppose, cautionary tales, but also really all stories of success where different banks overcame risks related to their brand and turned them into opportunity. Now, I want to begin by actually talking about the word brand. You have a brand. Everyone has a brand. You may not think you do. You may think when you compare yourself to giant organizations and brands you know and love, you may not think of your bank brand in the same way. But whether you like it or not, whether it's good or bad, robust or small, you have a brand. Everybody does, because a brand is simply what people think about when they think of your organization. And so it exists whether you like it or not. Now, the thing that we have seen too much of is that sometimes the realization of the state of your brand and what you should be doing with it is not, again, in the purview as much as it should be or as soon as it should be. And the reality is you are playing in a game. You are on the field, whether you like it or not, with your brand, because you have to be if you exist. And you have to, in any good football game, we'll use that since it's football season, you can't just play offense or just play defense. You have to play both if you want to win the game. And the brand can either help or hurt that effort. It can help you defend potential risks, or you can actually capitalize on opportunity. But the idea of playing both the defensive and the offensive when it comes to branding is often not even considered. There is no playbook. You don't know what plays to call. There's no planning for each one of them, or even awareness of what doing good defense or doing good offense looks like. So as we get into this is poll number one. I'm going to double down on that idea of expansion mode. And so I would like for you to select of these answers which best describes your bank's expansion plans. So A is that my institution aims to grow into new geographic or demographic markets via M&A. B is that you aim to grow into new geographic or demographic markets organically. C, my institution plans to grow within our current market only. Or D, we are not expanding at this time within our current market or targeting new markets. And so what is interesting about the answers here, and I'm seeing them come in, is that so a lot of M&A and zero are not expanding. And I was going to say, if you pick D, today's conversation is not going to be that relevant to you. It could be in the future, but if you're not looking to make any changes or grow, then you can maintain with status quo. But if you are trying to grow in any way, either demographically or via M&A, or you're even trying to double down on the markets you're in, and it looks like we've got some of that, but the majority is in M&A or organic, and now organic actually tipped above M&A, so both significant. You actually have both risk and opportunity that could be quite high related to your brand. And that risk especially is what I'm going to focus on today, because you have certainly heard tale of what branding does, and I'll touch on that when it's done well. But you might not be thinking about your brand in this way as an asset or a liability. And I want to encourage you to start thinking of it absolutely in that way, as it is an intangible asset. And in fact, brand equity equals, by definition, assets or liabilities driven by the brand that add or subtract from business value. So if your brand is inhibiting your ability to attract people, to get customers, to move into new markets, etc., that is actually a liability. If it is helping you, if your reputation is good, if people love you, if you have high awareness, that is helping. And so the combination of those two things needs to be considered. And brand equity is not just a fluffy metric. Brand equity is a real, tangible business thing. It has been proven over time and over decades, but even in one little example here, there's a reason why Dell is worth less than 1.3% of Apple. And it is many things, but at the top of that list is the brand. And so brand valuation is a metric that exists in the world. In financial, it is less of a thing being considered, especially in M&A deal making, whereas in other industries, it has started to be. And so I'm here to try to bring to light learnings from both organizations who have considered their brand during prior to M&A or during M&A, as well as those that have had to reconcile post M&A and made decisions with their brand. And what you see here too, a brand has been proven over time to provide incredible business value to outperform the market. It is, according to Forbes, your most valuable asset, period. And so thus for banks, like each of you, brand is a real business thing. Now, a little more data. What we are seeing is that more and more organizations are considering their brand as a part of business. And so this was a survey taken at the last financial brand conference by Adrenaline. And so what you see on the left are perceptions of how brand impacts business. 3 of 4 people actually said our brand value critically impacts our business value. And another 21% said it's important but doesn't affect our performance. And 4% don't think about it at all. And that's good. At least they were honest. But then on the right, and this was a little surprising, over a third of institutions had actually refreshed or fully rebranded in the past 2 years. And the big reason for that, COVID forced rebranding for a lot of people because the contextual landscape of everything changed. But about a third had considered that. And then another over half had said they had done something in the last 10 years. So this is where we sit today, but there's another important dynamic to consider. And it's this idea of blue ocean relevance. And if you're not familiar with a very famous branding methodology called red ocean and blue ocean, all that it means is that in the red ocean, everyone is doing and saying the same things, and it's hard to stand out. And so as a bank, you are selling and offering the same products and services basically as other banks. If you weren't, you probably wouldn't be insured by the FDIC. So you have to, in a way, be in the same red ocean. But the opportunity is to say, do, or create a brand reputation that makes you stand out and elevates you to this blue ocean area. Because when you elevate to the blue ocean where people just truly like you, and it's not about rates or pricing and fees, they will stick with you. They will be loyal to you. And that is when the brand is working for you. But the financial industry today, most brands are very much in the red ocean. There is an incredible sea of sameness. And there's a reason for this. You don't want to be too innovative as a place where people put their money and need to trust in you. So sometimes innovations associated with risk in ways that might seem unbecoming for a financial institution, when actually it has, on the whole, now hurt the industry because of the immense amount of repetition, commonality, and genericism that exists in bank names and brands. And this has now become more than just a nuisance or a hassle. It's become a business risk. So, for instance, what you see illustrated on this page are 40 some odd of the 231 First National banks that exist in the country today. First National Bank of wherever. Maybe they shortened to 1ST or FNB. Doesn't matter. Still the same name, still presents the same risk if you are moving into an area where there's another First National Bank. More on that to come. And if we look at the most common names used in banking, there are actually more than 5,000 instances of the 20 most common bank names, which are, as you see here, state first is number 2, trust, community, farmers, citizens, county, people, and on and on and on. So if you see all or part of your name on this list, chances are that you don't legally own your name. And what that means is that it's going to be difficult to stand out, but also you may face legal risk. More on that in a moment. And also, speaking of sameness, there's a lot of sameness across the board. There's a lot of eagles. There's a lot of trees. There's a lot of stars. Again, because these are common symbols of things that people associate with stability and with things that represent things they like, positivity, and because everyone else is doing it. And so the idea of actually looking like your neighbor was something decades ago that banks were trying to do. They were trying to look like the bank in the community next door because it made them more seemingly relatable, approachable, trustworthy, etc. But now, especially with the proliferation of, the internet, that is no longer a thing that is good. It is very bad to have the same as others. And then when you look at marketing, it's all done the same way too. Even when you're trying to be local and be unique, you're actually ending up saying the same thing that everybody else is saying. And so what the landscape fully looks like is this. You've got other community banks, and that's what we were just looking at in this red ocean, is just this one sliver at the upper right. You are actually also competing both legally and in practice for consumer mindshare and share of wallet with credit unions, with regional banks, with national banks. You know this, I'm just reminding you, and even with fintechs and non-banks who are penetrating different specialty sectors. And ultimately, all of this is compounding and cutting in on your ability to get market share, to stand out, and to even defend yourself. And not to make you panic, but there are reasons why you need to think about your brand for literal business continuity. Another poll: which statement best describes how your bank views your brand? And so it won't hurt my feelings if you listen to me just now and now you believe everything I said, but the bank does not. So speaking on behalf of the bank as a whole, vote for A, your bank believes your brand critically impacts your business value. B, our brand is important but doesn't affect our business performance. And C, we don't think about brand. And so a few votes coming in so far, looking where I hoped it would be, but it's okay if it's not. Some people don't think about it. Some people think it's important. The majority, at least so far, believe it critically impacts business value. And as you recall in our survey, and these numbers are maybe tracking towards the survey we did last year, where it was 75% basically voted for A, another 21% voted for B, and another 4% voted for C. And I'll say this too, if there is so much executive belief, if you're in the C category, if you're that one vote there that has voted for C, you may have an uphill battle. But if there is at least someone in the organization that can champion it enough, I have been in front of many CEOs and many boards that absolutely did not believe in brand until they experienced the process of actually researching, talking to peer banks, and seeing what happens if they didn't make change. And so that changed their perspectives completely. And so you could be in that scenario, or you maybe are in a scenario where people do believe and do realize it's both a challenge and an opportunity. And that gets to this next idea about, is your brand helping or hurting your bank's ability to grow? And so a third poll question related to the last one: do you believe your current name and your brand? So, and when I say your brand, that wouldn't be your name. This could be, maybe you've got a good name or a decent enough name, but you don't have a story that actually resonates or things behind it. So do you believe your name or your brand could limit your growth potential? And this could be because of geographic ties. It could be trademark ability and lawsuits or potential for lawsuits. the general inability to stand out, or something else. So A, you say yes, it limits us today. B, you say yes if we expand to new markets or audiences. C would be not today, but it could in the future. And D, meaning not at all. So I see some results coming in, a few not at all, which is great. And if you are in that position, that is an ideal position. Sometimes people believe that is the case, but there could be some things that you see through stories of what's happened to others that causes you to think otherwise. And I've seen that happen many times. And then there's actually the majority of votes are in the camp of C, that it's not limiting us today, but it could in the future. And that makes a lot of sense. And actually, that is the reason why we're here today, is for those C categories that don't even realize that it is limiting, but see the potential. And then we've got votes for A and B as well, that it is, you do realize it's limiting, or it's limiting if you expand. So let's go to, and thank you for those results, let's go to some real stories. And this is where even the most cynical of C-suite leaders or board directors or board members I have seen, again, really be surprised and change what they thought they knew because they went through something. And so I am telling you about these stories of actually tremendous banks, with all 4 CEOs of all 4 of the banks I'm going to talk about are great people, great humans, ones I am friends with, and ones that learned a lot through this process, but ones that overcame risk that the banks were experiencing because of their brand limiting their growth, to then turn them into opportunities to grow. So speaking of risk, bankers' favorite thing to talk about, there are 3 primary risk areas related to branding. And this is the thing, if you take anything away, take this away, because these risks are real, they exist, and they are not thought of enough in planning or due diligence related, especially related to M&A, but also related to organic growth, including going into new markets organically. And this number 1 area is legal risk. And I mentioned a version of this earlier. If you have a common name, if you're one of the 5,000 instances of the 20 most common names I mentioned, you probably do not legally own your name. If nobody legally owns a name, then the rights go to whoever was in the market first. So if you have a common name like Citizens or Security or Farmers, and you are trying to move into a market that already has a Citizens or already has a Community or already has a Farmers, this includes credit unions too, by the way, you cannot legally operate in that market by that name. They will have rights over you. So that's legal risk. Reputational risk is about what people think of you. And so this is maybe not as hitting you in the face, because you can operate, but what do people think of you? Are they confused by you? Do they confuse you with someone else? Do they think of someone else's bad characteristics when they think about you? Do they not think enough about you? Do they not think your bank is for them? That's reputational risk. And then operational risk, certainly something you deal with a lot in a lot of other areas. When it comes to branding, there is what I am seeing now, a proliferating instance of operational risks related to brands because of the M&A activity primarily. Brands are it's also division. We see this happening with division brands too, sometimes with wealth, insurance, etc., but mostly with acquired institutions. If you acquire an institution and let them keep their brand and you begin to have multiple brands, I am here to tell you there is a 99% chance that is a bad business strategy. And that is primarily for the reason of the more brands you have, the more diluted your brand becomes. And so that falls into reputational risk, but also operational risk, because the more brands you have to multiply everything you are doing at the bank by that number of brands. online, mobile, backend, marketing, and then you have to comply on different levels with all those brands. It is operationally can become a nightmare for your employees, even for your customers, but that has real risk associated with it. So those are the three areas. And I'm going to talk to you about success stories, as I mentioned, of banks that were experiencing these areas of risks but overcame them. The first success story in this bank's story, there was both legal and reputational risk due to their current brand. And so the question that they thought about, or the question that you should also think about related to this type of risk, as we expand, is our name or brand problematic? And if you asked them many moons ago, most of the C-suite would say no, it's great, it's perfect. So we're going to start this story in Ruston, Louisiana. Actually, Shoudrant, if you know your Louisiana, even smaller than Ruston, but Ruston was the biggest related town near where it was founded. Community Trust Bank had become an absolute beloved institution in this area of Louisiana. I mean, truly beloved, incredible people, incredible growth, incredible reputation. But they had a lot of plans to get bigger and to do more. And so when we met them, they were closing in on $3.5 billion in assets. And this is what their footprint looked like. So they were in northern Louisiana, but they were expanding actively into Mississippi and Texas. And as they were expanding, they started to realize something, and we pointed out in a study that there were almost 300 other institutions in this footprint with either community or trust in their name. And so they realized, wait a minute, that could be a problem. And I am here to tell you, this bank did not want to change. They had to change, but they have since realized that that change has enabled growth that they couldn't have experienced otherwise. And so in the process of renaming and rebranding from Community Trust Bank to Origin Bank, which was one that had emotional ups and downs and all kinds of stakeholders that needed to be involved, and I'll walk you through how it was done very successfully. This bank now lives and breathes this brand of Origin. They can't imagine being anything else. They embody it, they exude it. It is them in every way. And actually, the CEO said to me after we launched the brand that they now looked on the outside like they were on the inside. And so their brand actually hadn't kept pace with the sophistication and advancement of their people. So this was then launched in a way that was very deliberate and very explicit, especially in their legacy markets of Louisiana. It wasn't as important in Texas and Mississippi, where they weren't as known and they had LPOs, they were going for business play. They didn't have the established awareness of that reputation that needed to change. But in their core markets, they were very, very careful to say, we are changing our name, but not who we are. And we are only going to serve you better. We are evolving into Origin. And you see here, same bank, same people, same trust. And here's why we're doing it: to better serve you better. So you're mitigating risk for any potential attrition. And by the way, after launching over now 60 some odd brands in this country over the past 20 years, there has never, not one time, been a loss of note of customers because of a brand change, ever. Because ultimately, if you do it right, customers don't care what your name is. They care who you are and the service that you give them. So it creates opportunity where you need it, and it retains legacy in a way that you need it. And hopefully all of those things go in a flywheel that it all keeps going. And so here we're looking at how the market started to see Origin show up. So new signage, new buildings, new branches, new advertising in all of their markets, and in their branches, converting from what they had to existing, doing it as efficiently as possible, reskinning things. They kept their blue color, but making a big splash, and then even creating new environments. So when you rebrand, a consideration is in current branches, you want to do it as efficiently and effectively as possible, but don't ever forget that it is more than just signage. There's a lot of reconciliation, remediation, things on the inside that need to be tended to and converted everywhere your name exists. So it is a process, but that then affords you the opportunity to do new experiences built on a whole new brand. So this was a major renovation in the building where the chairman and the CEO actually sat. And after we rebranded, they said, this building, this doesn't look quite right. We got to make this look better. And so this was now the new manifestation. And then they went public, and there's the chairman, Drake Mills, with his good friend, Terry Bradshaw. And here they are going public on the NASDAQ with Origin. And they have since grown and again, lived, breathed, embodied this brand in every way. I can't say enough about the quality of the people and the leadership at this bank. And then just last year, made an acquisition of another bank, BTH, and this enabled them to grow significantly. Further, Origin has been named a top 3 best bank to work for the 10th consecutive year as of last year. So they are incredible. And here's what their asset growth, 151% since the rebrand over a period of 7 years and growing. And so that is success story number 1 of Origin, mitigating both potential legal and potential reputational risk of a name problem and then a brand relevance problem in new markets where I'm trying to grow by rebranding. Success story number 2. This is going to focus on really just legal risk, although in many of these instances, there's a combination of all of these things, but this was really one about legal. And so we're going to jump to not too far from where we were actually before. We're going to go to Longview, Texas, to another wonderful bank of people who are some of the most special you'll ever meet. Were called Citizens National Bank. Again, a name you've probably heard of before. And this is what their footprint looked like in East Texas. And they had a new CEO who had actually was from this area, but had gone to Chase, came back, and he said, I need to do something. And at the time, he first said, and this was a quote about the culture at the bank, we have 3 rules: no jerks, work hard, and do the right thing. And so he knew that his name was potentially a problem, but at the time, he really knew that his operational model of his branches were a problem. So when we began working with him, and we focus on both brand and branch transformation, we started with the branch. And so made that change. But then they did something. They acquired a bank. They acquired a bank called Union State Bank in Austin. And what was interesting is that they had previously operated with other Citizens National Banks. So you see this circle here. There were other Citizens National Banks that were in the proximity of where their network was. And they thought, oh, we can coexist. Well, when they moved in the Austin area, this other Citizens National Bank, and by the way, there were 20 banks in Texas with Citizens in their name. There were 5 specifically Citizens National Banks. This other Citizens National Bank said, we will sue you. You cannot come into our market with this name. So they had to change. That led to a new bank, a new brand for the same bank, Vera Bank. We wanted something unique, something that was different that we could trademark so it would be uniquely ours. It's simple, it's easy, it's distinctive, says CEO and President Brad Tidwell. And so Citizens National Bank became Vera Bank, also a lot fewer letters, so a lot more distance projection here. And then with that brand, they were able to build from net new even more equity that they never could have with Citizens National. So as they expanded into new markets, they could expand with a brand that people would remember. And something notable also, Brad Tidwell became a bit of a spokesman earlier for the security and soundness of many community banks across the country when we had the Silicon Valley mini crisis. And he did it under the memorable name of Vera Bank. So in totality, this rename, entered and rebrand, enabled their entry into multiple new markets. It helped accelerate their growth to the tune of a 95% increase in assets between 2018 and 2023, and gave them a new currency of brand equity that they just didn't have, nor did they know they needed, but they now benefit from. And so we'll get to now success story number 3. This is a story of reputational risk. Now, what you'll see is there was some potential legal risk and potential operational risk that was overcome, but at the time, the main risk was about reputation, with the question, are potential customers attracted to us or confused by us? So now we're going to jump across the country to Dickinson, North Dakota. American Bank, they had investments, trust, and insurance. It was an American Bank Center. And they had started acquiring. So what you see here are recent acquisitions they had made, and they didn't quite know what to do with those acquired brands. They kind of said, they'll stick around, we'll let them operate. They weren't sure. And they knew they had a bit of a double whammy problem, and credit to the CEO of this bank, Dave Ailes. He realized, and after discussions and realization about mitigating risk and being proactive, he decided, he led the champion, he was the champion of change because not everyone was in the same boat, that not only did they need to consolidate brands under a single name, but that name needed to change to something they could own. So American was not geographically limiting, and at the time they had not yet run into any other Americans, but he knew that they could in the future, and they surely couldn't stand out. And so kudos to the courage and forethought that went into that decision. And then what happens when you make a decision like that, you then can craft a brand from the ground up that absolutely reflects who the bank is. And so this brand, it's going to look very different from Origin, very different from Veribank, because it was crafted for them of unique DNA to this American bank in Dickinson, North Dakota and Montana. And so these are all the attributes of them: future focused, pioneering, empowering, and their brand position we created was finding new ground. And through this process of rebranding, they consolidated under the singular name and brand of Bravera Bank. And so on this one, I'm going to dive a little bit deeper into what truly brand components are. What you see here is an eagle, and I showed you a bunch of eagles before. This is a common symbol depicted in a new way, and actually in a badge. And badges are one of the most stable and historically strong forms of branding. So this badge looks like a moniker, a seal. It carries with it a sense of stability and trust. And there's also the idea of the word bravery in the word Bravera, that even though this is, by the way, a made up word, it's based on a real word. So it makes you have associations with it that are akin to that real word, but makes it ownable to the bank. And ownability legally is something very difficult today. And that's why you see, if you made up or fanciful names like Bravera. But as you see this come to life with imagery, people, all local imagery of their communities, of their people, sub-brands now with commonality and consistency with wealth and insurance, launched to their employees in a way that fosters unity, that brings people together with stories told, rooted in resilience, new cultural standards, and then communicated to customers. We're headed somewhere new and you're invited. Telling a story to customers that attracts them, that makes them feel like this bank is for me, forging a new way to bank, we're growing a financial future together, and then told outwardly on the website and on the very things that go in customers' wallets. And you see here again, as this brand comes to life, the pattern, the textures, the iconography, it feels very unique and it feels very them. There was a great pride of place, a sense of entrepreneurship, and then you see advertising here. It takes courage to follow your dreams. Forge your path was their tagline. And so this brand has come to life across every channel in every way. Here is the branch environment on the inside. Here is signage on the outside. It looks so good. It looks Photoshopped, but those are real pictures of what those signs look like before and after, and what a building looks like before and after. And this is their headquarters downtown. And one of the most interesting things the CEO said to me not too long ago after this launched is, People now tell me they see Bravera everywhere, but we're in the same place as we were before. And that's such a testament to what a brand will do. He actually overcame the risk of running into legal trouble, of not being reputationally relevant, and having potential major operational inefficiencies with multiple brands, and turn that into a positive that has brand equity compounding on itself. And so, in totality, reconciling those silos with M&A fostered cultural unity, new brand awareness, new advocacy, new equity generated as a real measure of business value. And then they're set up to geographically grow, and they are growing in North Dakota, in Montana, and beyond. And a fourth success story. The risks here overcome by this bank were both reputational and operational. And as you see, they were significant. And so the question here that they asked and that we answered and helped answer in partnership with them, is our brand inhibiting business efficiency and or growth? And this is why. So if you look at this bank of, by the way, also just tremendous people, leaders of character, that of dedication, of hard work, and the best of intentions. They had grown this way because they believed it was the best thing for their customers and for their bank. And over activities of discovery and over time, they realized that it wasn't, because these multiple brands, and they had 12 of them, were actually competing with themselves. They were cannibalizing their own market. And they didn't realize that until they started to really look into it. And it's because what got them where they were, that they believed in so much, was no longer what was going to get them where they needed to go. And there was another phenomenon that is related specifically to the branch network specifically, the idea of the network effect and achieving critical mass with perceived convenience of locations. That's the number one reason why customers choose to do business with you. And they were dividing their network effect power by the many brands that they had. So simply by consolidating statistically, they would get and have gotten on the upside of this curve, that their market share is exceeding their branch share instead of the opposite, because they had divided themselves, again, unintentionally. And something else that sort of blew their minds, they thought that customers wanted the local county bank. Not true. 9 in 10 want a bank that is at least statewide. They would prefer if it's statewide or involved in their local community, but 43% either actually want a national bank that's not involved in their local community. So this was a bit shocking. The takeaway for everyone is that scale is important and customers want scale. So in this process, we began by telling a new brand story, past to present, generation to generation, hometown to big city. Serving more is our charge every day. And this story, and there was a lot behind this, it wasn't just a story, a fairy tale, it was a strategic position for them based on many inputs. This story of serving more became their new mantra to rally around. And so after a lot of very critical inputs, decisioning, even a whole day long session on brand architecture involving all of their regional presidents, who, as you might imagine, were not really thrilled about losing the perceived autonomy of the fiefdoms that were their individual brands, they made an incredibly courageous decision to move to one singular brand. And that is what you see here. So they chose to retain the park name. They're not the only one with their name, but they have a big enough presence and enough power in the regions where they serve that they felt it was a safe and sound decision to keep that name, but consolidate all the others under it. And here you see this brand coming to life and the positioning of it coming to life all together now. Richland Bank is taking on our family name to become Park National Bank. And because Park National wasn't a net new name or wasn't foreign, and everyone who banked at Richland kind of knew they were part of this Park family, really there was very little risk to mitigate about people being upset. It felt like such a natural evolution. And then as it came together, this is showing their headquarters signage. This is such an upgrade from a perception standpoint for new customers, especially, but also for existing. This is an ATM that needed a little love and was upgraded. And look at the dramatic difference of what was a complete hodgepodge of all different brands, but also not powerful brands, move to such a beautiful, prominent, powerful brand. And here you see again the inside and outside of how it came to life on branches. And then finally, it led into a series of marketing and advertising for them that's really been game changing, where they have profiled small business customers as well as regular deposit customers. And they have a new theme of what means a lot to you means a lot to us. And they talk about the banker is talking to their customer saying, I understand their community, I understand their business. And the customer is saying, that's why I choose to bank with Park. They know this is about people. This isn't about making money in banking. So this turned into something that's had legs for years and that has extended across all ways, business and consumer, all channels in reputation building. And this quote from Dave Troutman, the chairman and CEO, incredible human, he says that what could have been a sterile and frightening exercise has produced a sense of unity and purpose we've not had for years. And the leadership, again, of this bank was not ready to change because they believed that what they had always done was still worth doing. And things had changed on them that were actually, once they saw how the multiple brands were adversely affecting customers who didn't know that they could use the ATM on the other side of Ohio, or their individual people who were battling with each other and having to do everything times 12, they had no idea the risks that they were taking. And now we're experiencing the opportunity that has been created from overcoming those risks. And so major operational efficiencies, because they had gone 12 wide before they changed. They had brought people, communities together inside and outside of the bank, and ultimately changed the growth trajectory potential. So in summary, do the due diligence you aren't doing. And this idea of due diligence is such a common one, especially in the face of M&A. You're doing every type of due diligence you can think of, but most are not doing this type. And other industries have started to catch on, and they are now. Retail, hospitality, these are industries that have been a little bit ahead of and predictive of some things that have happened in the financial industry. They have realized that brand consideration, when you're bringing any two or more than two brands together, has to be in the consideration set at the time that deals are being considered, because there are major implications, upsides, downsides, opportunities. And if you don't even know what those options are, you can't make as good of decisions or even have enhanced negotiating power. So it truly is due diligence, whether you are M&A or just jumping into a new market geographically or demographically. And ultimately, it is because brand equals business. Brand means business. It's not just your marketing people sponsoring the local football team. It is about truly driving long-term opportunity and mitigating against short and long-term risk. So in each of these cases, in Origin, in Veribank, in Bravera, and in Park, all four led by just brilliant and just good people, CEOs, leadership teams behind them, in different communities, from Louisiana to Texas to North Dakota and Montana to Ohio and the Carolinas. All of them overcame risk related to their brand to create opportunity with their brand. And I hope that each of you, reflecting on your organizations, might see some parallels where thinking in this way could help your bank advance sooner, mitigating potential negative and capitalizing on the positive. So hence the title, know before you grow, mitigating the risks of your brand and the state that it's in, especially if you're in expansion mode.
All right. Thank you so much, Nina. That was a wonderful presentation. And if you're ready for it, let's start with some questions from the audience.
All right.
So the first question, what is a traditional timeline from deciding to update a brand to launching it to the public?
Good question. On average, it is between 12 and 18 months. And this includes the period of stakeholder alignment and discovery. It can include market research. Oftentimes, if you don't have market research, you need to do some amount of research and discovery. And it takes you through name change. If you don't have a name change, that timeline can be shortened between 9 and 12 months. If you are doing a name change, on average, again, it elongates it by a number of months because you need to allow for stakeholder alignment, oftentimes for board approval, board alignment, and for intellectual property validation. So once you have names, and you need to make sure they're at least initially vetted, you want to make sure that you can legally own them before going forward with them. So all of that is part of the process. And I say that those timelines with a lot of certainty because we've done a lot of this. And so if you think you can launch a new name and a brand in 3 or 4 months, I more power to you, and I wish you good luck. There is some risks and some challenges associated with that. So average is 12 to 18 with a new name, or 9 to 12 with just a new brand and an existing name.
Great, thank you. The next audience member is wondering, how do you view specific brand naming for a specific specialty brand taking place through M&A? For instance, keeping an old bank name for the divisional specialty with the rest of the bank taking the new name of the acquirer.
Ooh, I like that question because the answer is absolutely no. That is a very bad idea. And I'll explain why, but also it's such a good question because it's the first place that most bankers go. So wait a minute, I'll just keep my existing, and to target my new market, again, could be a new geographic market or a new demographic market, I'll create a new brand for that. Then you get into the same problem I just talked about for banks having to get out of, which is you are diluting the power of your brand and you are creating more hurdles operationally and reputationally to go through. So, not to mention, if you just change initially for, let's say it's a new market and you're jumping into a new geographic market and you create a new brand for that market, what if the next market is not relevant to that brand you just created because it was specific to that market? And then you start to have, again, a proliferation of brands. It is generally not a smart strategy, and so I'd advise against it.
Thank you. This next question will stick with M&A. So do you typically speak with banks before the deal is announced, and how are you working around high confidentiality?
Yes. Okay. Also a good question. Historically, so I mentioned we've been doing this for 20 years. 10 years ago, never. 5 years ago, not really. But in the last couple of years, we have started to engage prior to M&A or during M&A simply as an advisor, as a consultant. So if you think about during any due diligence of M&A, there are consultants hard at work, and there's a few big names in the industry, big ones, small ones, and they are evaluating everything, every piece of technology, every legal entity, everything about your brand, about your bank, and not about your brand. We have started to get engaged in those conversations simply in a light advisory capacity to explain a couple of things, to say, here's the assessment, and there could be some market research that is associated with it to get a little more data and insight about what are your awareness levels, what are your association positivities or negativity factors, etc. But what you start to learn is not only assessing current state, but what are the options? And this is the biggest missing piece of data when multiple brands are coming together. You think, oh, maybe we'll take my name and his logo, or his logo and my name, or we'll have an acronym mushed together name, or I don't know. So thinking about what really, truly, strategically all the options are so you can make the best decision, even in due diligence, pre-deal, it not only can help you avoid major pitfalls, it could help you actually have negotiating power in different ways. So it's something that has not historically occurred as much, but is starting to happen now. And it's such an easy step because you are simply a strategic advisor in the same way your technology advisors and your other legal advisors are involved. We're involved as a brand advisor.
Great, thank you. Okay, this next question. This audience member is wondering if there is reputational or legal risk for a bank with a state name in their names, and they're wanting to venture into a new state. So if they have Ohio in their name, for example, do they need to change that?
Yeah, so there is nothing legally that requires you to do so. In other words, if you are Ohio State Bank, I don't know if there is one of those, and you want to go to Indiana, you can do that legally. Now, the question is then reputationally, what do people in Indiana think about Ohio State Bank? And if I'm a resident of Indiana, do I want to do business with Ohio State Bank? And the main metric that a market research firm would tell you is that the customer or potential new customer would think that bank is not for me. And so it's not a smart decision in that you're setting yourself up for failure by by having a literal, what we would call a geographically limiting name. So if you have a county name, a state name, or a region name, or it could be something like coastal, but you're landlocked. Those are what we would call geographically limiting names. They have been statistically proven to reduce effectiveness significantly of acquiring new customers. So there is nothing that requires you. In other words, you can do business anywhere by any DBA name you want, but strategically, it is a very poor decision to be in an area that your current name does not include.
Okay, and we just got in another question that kind of builds on this. So this attendee is loving your examples. So what additional risks exist when your name is aligned to a geography and you want to expand? So is there a risk to losing your current market if you change something, or the risk of not changing it and being irrelevant in the new geography?
Yeah, here's what I'm here to tell you. When done right, and because of the sample size of doing it so many times and having seen what happens, when done right, the risk goes to literally zero. It goes to zero because you communicate how everything about the old that was good is still going to be there in the new. Now, there are major risks associated with where you're going if you have ties to where you came from. Probably more than anything, the association that you're too small or you're not sophisticated enough for what I need. So there's definitely risks of retaining existing when you jump to a new geography with things that the new geography knows are associated with the old geography and therefore not for me. But the risks of alienating, if I really like the word Lakeview, because I love lakes and I do business with you and you're by lakes, if you change, I'm here to tell you that customer will not leave if you do it correctly and you launch, you communicate, you tell them what's changing, and that service will remain the same. So that risk truly becomes zero when done right as far as losing because of your current name.
Thank you so much, Gina. And this brings us right up to the end of our time. I want to say thank you for all these great questions from our audience. This was fantastic and really insightful. And of course, thank you to you, Gina, as well. As a reminder for our attendees, you will receive the recorded version of this webinar within the next 24 hours. And this webinar is also available on bankdirector.com. So again, thank you to Gina, and thank you for joining us today. Have a great afternoon.